Hello, good morning, everyone. So if you can hear me, just type a yes, so I will know that I'm audible. I can.
Yes,
Oh,
I can hear you. Good morning, Gary.
Perfect. Thank you so much, sir. Thank you.
Good
Thanks
morning.
for joining, sir. Thank you, sir. Thank you so much for joining us. All right, let's start. Okay, good morning to all our amazing participants. My name is Mary Ohaleto Woma from the Marketing and Business Development Team of First Central Credit Bureau. We are all welcome to today's webinar, themed Rethinking the Concept of Lending. Rethinking the Concept of Lending. The theme is one I am eager to pay keen attention to learn from our speakers, having seen their wealth of experience within and around the lending space. And I believe that you're also excited to benefit from this topic, knowing fully well that lending and borrowing is one of the major tools for the development of economy, expansion of businesses, as well as actualization of many people's dreams. Please note that this event is being recorded and will be shared with all registered participants. We also are aware that a lot of people are connected to this event via all our social media platforms. Kindly drop your questions and comments at the chat box, as they will all be attended to at the end of this section. So without wasting much time, I will be introducing to you the speakers of this great event in no particular order. It is my honor to introduce to you the Managing Director, CEO of Richway Microfinance Bank and the current Chairman of National Association of Microfinance Bank, Lagos Chapter, in the person of Mr. Aderele Oni. Mr. Aderele Oni is the Managing Director and Chief Executive Officer of Richway Microfinance Bank. He is a Director of Richway Financial Service Limited, Nigeria, and a Director of Richway Financial Service Limited, South Africa. He is an experienced banker with over 30 years professional practice and leadership experience. Mr. Oni has held and distinguished himself in several management and leadership positions, some of which include Managing Director and CEO, FBN Mortgage Bank, General Manager and Chief Representative Officer of the First Bank South Africa, President of South Africa, Nigeria Chamber of Commerce, among others. He is a fellow of the Chartered Institute of Taxation of Nigeria, fellow Institute of Credit Administration, FICA, honorary senior member, Chartered Institute of Bankers of Nigeria, and a microfinance certified professional, as well as a fellow African Board of Financial Inclusions. He is an alumnus of Lagos Business School Senior Management Program. He is an expert of corporate strategy, business development, and restructuring reengineering. Aderele has attended various leadership and management programs at INSEAD, Chicago Bott University, Michigan Business Schools, Wharton School, Denver, Canada, among others. Mr. Oni is an alumnus of International Visitors Leadership Program of US government. He is a member of Ikoyi Club and Lagos Country Club. Mr. Oni, you are welcome, sir. It is also my honor to introduce to you Mr. George Adebanjo Adebega. He is a Managing Director, CEO of Money in Minutes Limited. Mr. George is a British-Nigerian lawyer and a well-rounded entrepreneur within the LendTech and FinTech space. He is a confident communicator and proven leadership skill across a range of successful financial service organizations, such as GE Money Bank, Evershield LLP, Capital, Computer Shell Computer Shell Technology Service, and Loan to Go Limited. George has extensive exposure in regulatory laws, consumer finance, debt recovery, mortgages, credit card, payment service technology, and a powerful network of industry peers. He qualified as a barrister of England and Wales in 2010 and in 2012. He attained a Master of Law degree from BPP University of London. Due to his continuous pursuit to enhance and broaden his knowledge and capabilities, he attained a Master of Business Administration degree from said business school at the prestigious University of Oxford, 2020. His track record of career progression is founded on their ability to build relationship with people, taking responsibility, identifying solutions, and then delivering results. George is the co-founder and chairperson of Ethical Resolve Limited UK and the founder of Money in Minute Finance Company Limited, a Central Bank of Nigeria licensed finance firm that is working towards helping the problem of access to finance in Africa. Mr. George is happily married and blessed with 4 beautiful daughters. Mr. George, you're welcome, sir. It is also—
Thank you for having me.
Welcome, sir. It is also my honor to introduce Mr. Abasiama Idaresi. Mr. Abasiama Idaresi is the CEO and founder of Wide Fusion Holdings, a technology holding company with digital and fintech subsidiaries. It started over a decade ago as the first and largest digital marketing agency in Nigeria and across other countries in Africa, such as Ghana and Kenya, with over 100 staff and still growing till date. Abasiama holds a bachelor's degree in Information System and Management at the University of London and MBA from Manchester Business School. Mr. Abasiama is passionate about entrepreneurship, venture capital, technology startups in Africa, and has invested in over 15 technology companies across Africa. Mr. Idaresi has been recognized as most influential people of African descent, NIPAP, and the French think tank Sechure Institute of Paris as one of the young economic leaders of Africa. Mr. Idaresi, you're welcome, sir.
Thank you very much. Thank you very much. I'm privileged. Thank you.
Permit me to also introduce to you the last but not the least of our speakers for this great event, in the person of Luis Maria Salamina. Luis Maria Salamina is a Principal Operation Officer, Lead of Credit Infrastructure of Africa at International Finance Corporation, part of the World Bank working on credit information and secure transactions. She joined the World Bank Group in April 2014 to work in Sub-Saharan Africa, promoting reforms on credit information and support the financial industry in resolving challenges and gaps in data-related issues. She was the General Manager of the Credit Bureau, APC Bureau, South Africa, and Vice President of HSBC and Chase Manhattan Bank in retail banking in Panama. Luis Maria represented Alacred, the Credit Reporting Association of Latin America, at the International Consumer Credit Task Force, led by the World Bank from 2009 to 2013. Madam Luis Maria, welcome, ma'am.
Thank you. Thank you very much.
At this point, I will be introduced to you the host of this event in the person of my vibrant MD CEO, Oladimeji Peters. Mr. Deji Peters has over a decade of working experience in business development and analytics, both within and outside Nigeria. He is a graduate of economics and holds an MBA from Durham University. He is a professional and associate member of various institutions, which include but not limited to Nigeria Institute of Management, Chartered Institute of Stockbrokers, Microsoft Corporation, Chartered Institute of Administration and Fraud Examiners, among others. Ladies and gentlemen, Join me as we welcome the MD CEO of First Central Credit Bureau for his opening speech. Over to you, sir.
Thank you very much, Mary. Thank you very much, everyone. Thank you to the panelists, Basiam, George, Liz, Mary. Thank you so much for honoring our invite. It's been a great honor. And yes, to the audience, thank you very much for joining us. I guess it's tried to say that. Let me just start by saying that we in the credit bureau space we're doing so much. In the financial space we're doing so much, and indeed there's still much to be done. There's always room for development. What we've seen in the business practice, and this is not just cherry picking variables, cherry picking numbers. This is based on concrete analysis, is that there's still a lot of room for development. And so without much ado, I would just go really quickly into giving you a background as to why this is even necessary for starters, and then to also give you a clear an articulate understanding of why we have a wide range of speakers from different space to speak on this, and to perhaps educate and enlighten us more on the things that we may do differently. Yeah, so once again, thank you for joining us. Right. Right. Yeah, I'm just going to start again by saying that, let me probably drop my presentation so I can just speak around that as we go. Okay. There seems to be so much to talk about.
So you want to share your screen, sir?
Yes, I'm doing the right thing, yes.
Okay.
Mary, if you please share the presentation from there. For some reason, mine is taking a while. I'll just share the screen and then I'll move on with this. Right. All right. I'm just going to talk through the presentation in a way that is not necessarily consecutive. Again, just to give you a background to who we are as a bureau and what we do. These slides will be shared anyways with everyone, and so we can always have a look at it. And so as a risk company that we have, what we do basically is to collect risk profile about individuals and perhaps help them build a report that is credible. But then again, that is currently limited to the credit space. There's always a room for credibility analysis in other space, whether it's employment, whether it's work-related, vocational, or even school-related and other type of judgment cases. At the moment, the risk analysis is basically built based on the report received from financial institutions, the credit report, and then we build the analysis, we draw credit scores based on our own internal algorithm. And so the credit scores are then built into different products. We have different products. Some of them are X scores, nano credit scores, data credit scores, and all of that. But then as we go on, I would also give you a background to why we do what we do, and perhaps whether we are doing enough, and perhaps if there is also room for more development. You would see, for instance, that on the commercial side, we have the detailed credit score, the directorship, and other type of credit scores. And we also provide other type of services. Those are listed there as well. But then essentially what the credit score does for you is to give you just a 3 digits saying that this is how much we trust you, or this is how much you performed in the past. This is how much you honor your obligations. This is how you have a tendency to default. And so when you look at the spectrum here, you see that on the high risk, you have 300 to 629, which compromise of individuals that either do not pay on time, miss out on their installments, have overdue, don't meet up with the monetarium, whether in terms of the maturity, the length of maybe they perform on the mortgage side but not on the personal loan, or maybe they have an overdraft that they're not even aware of. And some of those dynamics can play in different ways. For instance, you would see that in the Nigerian market, the credit market, for instance, about 12 to 14% of the loans actually overdrafts, and in some cases, those individuals are not even aware of such overdraft until maybe they try to apply for a loan and then they get a rejection simply because there's an overdraft. But anyways, the credit score matrix runs using the payment history, the total amount on the type of credit, and then the length of credit, the number of credit, and all these are weighted into your score. And so the number of credit, for instance, will speak to how much credit you have, how much credit lines you've been allocated to such an individual, and whether or not they've been able to perform, or not, whether it's a mortgage, it's a personal loan, it's a credit card, all type of loans. And the more credit such individual gets, the higher the chance of saying, or the system is able to build a better credit score on such individual. Just the same way you say, if I do a transaction with someone, I know the person better than someone I've never transacted with. So basically, it just runs on a weighted algorithm to now provide a score for such individual. But I don't spend too much time on the type of reports. I'll just go strictly into the business of the day, which is exactly what the credit market is about, where we have, and perhaps whether we're doing enough in contemporary times. And I think I should start out by saying that, at times we could build solutions that may either to in the future become a problem, or we could build something that in real term or in the present term could actually be a solution, but in the long run or in future terms could actually become a serious problem. And I'll give you an example. You take something like the Tall Milan Bridge, for instance. At the time when it was designed in Lagos, you would see that maybe the biggest population was about 10 million or more, and it was adequate for that purpose. Infrastructure and the population, the infrastructure could sustain the population. But then you take another 20 years or 3 decades down the line, and soon enough you see that it's clustered with so much traffic, and you start to wonder what the problem is. The thing then is the population has jumped, but the infrastructure has remained the same. But if the futuristic thinking at the time when the bridge was created was what happens in the next 50 years. How, for instance, is our credit or financial market going to affect other economic variables like our GDP or per capita income or national income and all the things? Then the analysis may start to draw differently, and perhaps the solution too would start to have a more concrete or more sustainable answers. And so when you look at the credit market, for instance, you look at the players, you look at the prospects, the challenges, and you look at other key factors. But one of the things that we have seen in the market is there is a strong need for financial inclusion. And you see the prospect, you see that the need for financial inclusion in the Nigerian market, apologies for that, is extreme, and we'll get to that. If, for instance, and I'll give you another instance of a problem that looks like a solution. Sometimes in the US, someone, I think the president had decided that abortion was immoral, and so they had established a bill to say that, look, abortion was not allowed. Some 20, 30 years down the line again, someone did a behavioral analysis in the penitentiary, in the jail system, and realized that about 80 to 90% of the inmates were actually kids that were raised from single homes, cases of rape, and places where the mother was not really allowed to take, to have an abortion. And so those kids were ill developed, and they adopted. They did not. They were delinquent from the society, basically, especially. So they went ahead and performed other social ills. And at the time when crime rate had jumped in the U.S., despite the fact that the police was had increased, they had wondered why the problem was, there was a high amount of crime rate and there was a lot of drug on the street. And someone said, okay, we do this analysis, and uh, the conclusive report was what looked like a solution, a moral solution at the time, had serious adverse social economic problem in the next 20 or 30 years. And when you start to think of that in light of the further reports that we run, you start to draw that and say, for instance, where are we? And for instance, where are we going to be in the next 50 years? If you look at the GDP, for instance, for countries all over the world, I could share that video with you, perhaps afterward. You see that in the next 100 years, we don't even make it to the top 100 list. That's a video I probably should play while we're talking. But then you see, on the top 10, you see notable countries. You expect that in the next 60 or 70, you see one African countries, over 200 countries in the world, 55 in Africa, not a single one of them made it to the list in terms of the GDP performance for the next 100 years. And the projection then is, of course, based on forecast, is that, the financial system within the African space or the continent is not exactly viable or great, credit-wise, when you look at the analysis, and then you start to wonder what it is we're doing, and perhaps how we can do more or have a wider impact. And so in our analysis, we looked at financial inclusion being the major part of the prospect, the key things that we need to address. And then we also look at the data, so that if you go on CBN website, for instance, you see that they reported a financial inclusion rate of about 50%. Now, when you sit on the data, and this is not just cherry picking numbers, this is based on, again, concrete analysis, you would realize very quickly that the data in the banking space is easily about what? 40, 50 million, not 40 million. And then, of the, let's use CBN's figure of 50% and say we have about 50 million of our adult population of 100, of our entire population of 200 million, adult population of 100, we have about 50% of the adult population that are actually financially included. Now, over 50%, if you take a closer look to the percentage of non-financial data contribution, and then you come to the apologies. Unique identifiers from Federal Report using a BVN, you would quickly see, sorry, the values that jumped out for some reason. Share this differently. Anyways, in the analysis that we had run, we were quick to see that the data that was actually accurate within the banking record of your about 68 million came to about 40 million records that are valid. Some of them without BVN, some of them legacy records. Now, if you have 40 million, effectively you have about 60 million left out completely. Of the 40 million, there were cases of rejection record, abnormalities with data, inconsistent validations, and all of that, and the wrong mismatch. And so your data effectively came to about 30%. 35 million. Of your 35 million, let's take the figure, 65 million. So effectively, you have about 60, 65 million people out there with the potential, in some cases, who have never used any kind of financial, credit service, not to, they've never even gone vanilla on it, not a single credit service. And so we cannot even start to talk about an exotic mix of different type of, service, say, mortgage, personal loan, and commercial, all those other types. So there are about 65 million people who have never, ever used, credit in one form or the other, and still leverage very strongly on cash, either for personal use or for business users, leveraging on family and angel investor. The question then is, Whether or not that is sustainable in the long run, that's one. The question of whether or not, even if it's sustainable, is that the best practice, And so start to do more analysis all over the world. You look at the data from OECD and you start to wonder, why, we are doing things differently when academia and, journals suggest otherwise authoritatively. And so we look at that and conclusively, we can easily say that we only have about 30%, financial inclusion, but then we're not authoritative in that regard. So we will just work with CBN's figure of about 50% data, credit financial inclusion, right? So now about 50%, it then becomes a question of how do we reach out to the other 50%? And then you start to wonder whether or not, you want to extend the line of credit to someone who has never used any kind of financial service, whether there's too much risk in that. And when you look at the fintechs, for instance, I will come in with FDIs, the foreign direct investment. Some of them bring in as much as $500 million, and then they give us loan. In some cases, cash plunge. In other cases, they use other type of extreme measures for collection purpose. Some of those measures may be intrusive in some cases, maybe in some cases absolutely necessary. In other cases, maybe outrightly preposterous. So it becomes again a question of how it's sustainable. But then when we look at it and we put this in the BGC matrix, we say there are basically 4 types of customers: those that are willing to pay, those that are unwilling to pay, those that are able to pay, and those that are unable to pay. And so when you look at those quadrants, how does that apply to our 50%, extension, exclusion? And we start to put figures in all of these, and the extended figures will be shared in a different, slide with all of the workings. And so you see that those that are willing to pay, and how do we come across this data? We, from doing background checks on places, even on HR, Ingeli, Delta, and the rest of them, Minewi and the rest, we've traveled far. And in some cases, in this place, they don't even have access to a bank, let alone an ATM machine. So you have to travel far to even access a POS, just for cash for collection. So they don't even have access to the bank, the traditional banking system. And that's why we also think that the fintechs are doing great, because one thing they all have is the mobile phones, and with the fintechs we can probably reach them more. But then, not to digress too far, the overview we have here is just to say, okay, of our 50, those that are willing to pay and able to pay are star customers. Those that are willing to pay and unable to pay are brilliant prospects. Those that are unwilling to pay and unable to pay are people you should probably abstain with from their delinquents. But then those that are unwilling to pay but able to pay are also very dangerous, because in the sense that probably have the money, but they have the liquidity, but they don't want to pay. I mean, in those cases, that's where the fintechs, for instance, put a lien on their account and do the automatic rejection when the time is past due. And so, without further ado, we did more analysis on that, and we said, okay, within the market space, within the credit space, what are the things that we even in the traditional banking system need to do differently? In the fintech system, what are the things that we need to look at before we can actually now segment and target, this type of customers for this reason? But I won't take too much time on this because, again, we have speakers that will speak to this. We have some of the most profound voices, masterminds, from different space would guide us more on this. And perhaps when they are all done with that, we can then come back into our analysis and say, okay, maybe even in the question and answer sections, and say, these are the things that we prefer based on all of the things that have been said, but we don't want to create the conversation. And so without much ado, I will just hand this again over to Mary, and say a big thank you again to everyone for joining us. Thank you.
Well, thank you so much, MD, for that wonderful opening speech. Thank you, sir. Okay, ladies and gentlemen, the time we have all been waiting for is here. Let's proceed to welcome our first speaker for this event in the person of Madam Luis Maria Salamina from IFC, as she takes us through rethinking the concept of lending from the perspective of credit reporting. Over to you, ma'am.
Thank you very much, Mary. First, I want to congratulate you for designing this intervention and also for getting so many people. I know that Nigeria is big, but you have almost 400 participants in the call already. Mary, I just wanted to point out that there were some hands up. I don't know if you want to take those now, or should I just start my presentation?
Yes, ma'am, we can proceed. We'll attend to all questions towards the end of this program.
Okay, thank you very much.
Welcome.
So, building on Mr. Peter's presentation, I have prepared an agenda that I hope to cover in the 20 minutes I have. I put my watch just in case I'm going to exceed. But I want to start with emphasizing the importance of the credit reporting and not only on offering loans, but also for the whole ecosystem. Then I want to share with you some of our learnings, our experiences, and what we see it's happening. So maybe you can get some ideas for developing some of the solutions that we are proposing in different regions that may resonate with you. And this will cover, among other things, how COVID has changed the landscape of credit, and the need to build resilience, and then the sources of data and how we can use them, what are the challenges, what are also the risks on them. And we'll end with some of the trends that we see coming. So just to, again, emphasize the relevance of credit information, let me see if I can hide my top screen. I don't think I can, so it doesn't matter. So credit information contributes to not only building good and quality portfolios, but also improving and safeguarding the whole financial system of a country. When we talk about improving the resilience of the financial portfolio of the credit institutions, you remember how credit information's main objective is to reduce the information asymmetry. That is, you as a lender don't know as much of your potential borrower as they know. So the credit bureau comes to fill that gap of information. By filling that gap of information, then you as lenders will improve your management process of lending, the measurement of the credit risk, and improve your underwriting. By doing that and by adding the technology that is already available, you will be able to lower your operational costs, to implement risk-based pricing, to democratize the credit for the borrowers. And at the same time, you will be improving the portfolio quality by reducing the potential NPLs. And this also creates the opportunity of the financial institutions to improve their condition and risk ratings in the case that you want to expand your equity, to get more funding, but also will be an evidence that you can bring to the regulators that your portfolio is of good quality, is well managed, and maybe introduce and request for minimizing those reserves that hurt most of the lenders in capital requirements or reserve requirements. Another important contribution of the credit information is that it expands the access to new segments, to the underserved. Similarly, like we are reducing the gap of information of the individuals that already have some sort of transactions to evaluate them with. Now we are talking about what can we do with those that are invisible? And here is where the new tools, the explosion of digital and new technologies come to the rescue to again minimize that gap of information that exists with those underserved, with those micro enterprises, with those individuals that are in the lower income of the pyramid, and for the financial institutions to start generating new pools of borrowers. If you generate those new and grow your portfolio, then to serve these new segments, you need to develop probably new kinds of products and services. Also base your underwriting in less collateralized requirements. And by increasing their portfolio, you again improve your profitability and again improve the conditions of your companies in improving risk ratings, again to facilitate not only your growth, but also the potential for additional investments. Then finally, credit information also contributes in safeguarding the financial stability of the system. How? Information from the bureaus covers the whole spectrum of credit and credit performance of the population. You bring information not only for the financial institutions or from the financial institutions, but you start adding information from other kinds of lendings, non-banking and non-financial institution lenders, from retailers, from utility companies. And this provides the regulator with a full view of the performance of credit for the country, which will assist them in driving policy. It will also support them in the macroprudential supervision. Here is where they can evaluate whether those reserve requirements are able to be modified. It provides information for macroprudential policy, informing policy, and promote financial inclusion through the use of these tools. Again, enhancing the soundness of and the stability of the financial system. And finally, for the consumer, they should be able to then receive better terms and conditions in the forms of better interest, extended loan maturities, less reliance on collateral, because there is information to make sound decisions, and also contributing to consumer awareness. So this is a wholesome picture of the whole ecosystem and how credit information contributes to promoting growth of your businesses, but also growth in the economy. What are we facing now? We are faced with a crisis that we say COVID has ended. Yes, COVID has ended because we can go back to our normal lives, but it had changed the landscape forever, probably. And just to go over the history of credit information, For those that do not know, it started since the 1800s, when you used to just call by phone or visit your competitor and ask about information on the clients that you want to lend to. And it was usually negative information that was shared. It is surprising to me that there are still some countries in not so underdeveloped countries where this technique is still in place. So there is a lot still to do to move forward to where we are now. In the 1900s, the formalization and the creation of the big credit bureaus started, and it also started the development of laws that would regulate the system, particularly in mandating the credit reporting from the financial and regulated entities to the credit bureaus. In the 2000s, that was a great expansion due to also technology developments to have access to big machines that could handle great amounts of data, and the incorporation of new kinds of information like retail data, rental information, information on utility payments started to be promoted as well and incorporated in the credit bureau to boost the results of information that was only on credit. In the 2010s, it started a decentralization where many financial or fintechs started to emerge and develop data analytics that is used to analyze the information and extract value out of it. In addition to credit scoring, there are many other purposes of using the information from the bureau or from the data that is available in the system to contribute to the work at the financial institutions. And now we come to our times. And in our times, we are faced with COVID, we are faced with war and conflicts, and this is bringing us to challenges, but also opportunities. The health crisis of COVID left a lot of people without jobs, having to think over what the way of returning to improving their livelihoods is like. Some couldn't pay their credits. The regulators had to take some actions into how to allow for a space for time to go by and some moratorias to allow for the financial systems not to collapse. There are climate-related disasters that impact the smallholder farmers, and there is the risk of food provisioning. The conflicts seem to just increment all the time. There is Ukraine, but there are conflicts in all of the regions in the world, and this is creating displacements of people. And there is an emphasis on the consumer, on tightening the regulation that handles the protection and safeguarding of consumers. On the positive side, the same crisis and challenges that I've mentioned also created these opportunities and benefits, really. The emergence of new data, the emergence of new protocols in using that data. Open banking is promising a total disruption of what we know up to now. The digitization of the information, many people that didn't use mobile phones or transacted through the internet had to do it because there wasn't the possibility of doing it face-to-face. The extension of alternative data and scoring, the proliferation of technology and AI. All of these are opportunities. that were born, some of them thanks to COVID. But COVID, like I mentioned, hasn't disappeared. COVID is still has some sequels, and more important than resolving those sequels is to prepare for the future, because we have to expect that there are going to be different crises that we will also impact the way that we store the information, or that we use the information, or that we lend to customers. So, for example, the COVID created some specific challenges for those that missed their payments due to the crisis, but were really credit-worthy individuals that behaved well before the crisis. These are called the false bats, because they are now looked as if they were delinquent, but it was caused by some specific inconveniences, such as the result of they losing jobs or losing the work in their companies. There is an estimation of 50% of the firms that did not have enough funds to meet the debt financing, so this triggered an increase of NPLs. And then the banks retracted and rationed the lending for the consumers in general. The credit bureaus were faced then with one problem on reporting, whether to continue reporting and then impacting negatively the consumer, because it will reflect negatively on their reporting, or to simply stop reporting, like in several countries happened, and this impacted the whole ecosystem and the financial system. The basic recommendation for this particular characteristic that is repeated in all of the countries is to basically assign technical codes in the credit information reporting to those borrowers that were hurt in the crisis because of the crisis, and, for example, put some simple coding that when you read the report, you understand that that is the cause for their delinquencies, and that you could still consider lending to them because they had a better history before the crisis. These are some of the recommendations that were born from the work that the International Committee on Credit Reporting did. And there are some specific guidelines that I'm going to go very quickly through them to crisis-proof the credit information systems. One of the most important is to coordinate with the regulators when they incorporate reforms versus what the credit information and the credit providers are intending to do to safeguard their customers and the system. If the regulators are requesting to not report the information, then and the bureaus stop receiving that kind of information, then you are losing history that is necessary for when the crisis ends. It's the need that there is the need also to develop a guidance for disaster or crisis for the future. The technical codes that I mentioned before. It's important to evaluate consistently what's happening in the market so that these policies that the regulators are taking can be amended according to the needs of the market. The scores need to be calibrated, because if you leave them as they are, they probably will hurt the consumers. And there is already a new development of crisis business rating that incorporates the different aspects of the crisis into evaluating particularly firms and small companies, so that, for example, in insolvency reforms or when they are being restructured, these aspects can be considered. There are some industries that were more affected than others, and these are considerations that are included in these kinds of rating. Then dealing with foundational technology is also important. It's important to make sure that now that it is available, digitizing both MSMEs and the small lenders that are usually not digitized will really create the necessary environment to move forward. And very important in these days, start promoting the adoption and mainstreaming of alternative data. And talking about alternative data to promote inclusion, I bring again the work of the International Committee on Credit Reporting, where guidelines specifically for how to deal with alternative data were issued. As a background, known by all of you, really, the MSMEs and individuals, particularly again from the crisis, have generated great amount of digital data by using payment platforms, mobile phones to transact, creating information on their trade transactions, even social networks. So the theory is, or the hypothesis is, that alternative data can be used to assess creditworthiness, capacity, and willingness to pay the loans for those that were not served previously, and also to boost the opportunities for those that had already information in the systems. The challenges that we will be resolving with alternative data, or that have to be addressed when utilizing alternative data, is to resolve the lack of digitization and the minimal use of the digital platforms, identify what would be those unintended negative effects, such as potential discrimination when identifying the data that you can be used as alternative, and make sure that you address the one of the main concerns of regulators, which is the opaqueness of the scoring methodologies that are sometimes considered as a black box. So the demonstration effect, or being able to demonstrate what is considered in the scoring and in the methodology, will be fundamental. So some of the policy recommendations, and there were 12, relate to improving the availability and accuracy of information, expanding the credit information sharing to not only the credit providers, but beyond, to all kinds of data and data sources that could be useful for creditworthiness analysis. Also enabling, and this is going to be much important going forward, is enabling the cross-border data exchanges. And this is to facilitate trading, particularly in Africa, where there are so many trading corridors, but also to alleviate the constraints that are faced by refugees or by migrants. And finally, there needs to be a balance between integration, innovation, and competition. Just to give you an example of an exercise that we are doing in several countries, that we can do also in Nigeria if it is of interest, we have partnered with the regulator to, in some sort of sandbox, to see how the use of alternative data will impact positively in the generation of additional credit, of generation of portfolios of good quality, and expanding that access to the MSMEs that have not had the opportunity to have credit so far. So in this exercise, we have different activities that relate to the challenges that are faced, that need to be resolved in order to have the pilot. Digitization of small lenders is one of the most important, because if we are going to use all of these technological tools, they need to be part of the whole ecosystem, also with technology. Making sure that the right alternative data or the relevant alternative data is the one that will be monitored and used and incorporated in alternative scores. Need to assess the predictiveness of that data, and incorporate the use of other new technologies, not only the traditional scoring, but there is also new forms of psychometrics that can be used to address the unserved population. So here we do work with MSMEs together with data aggregators and data collections that are usually credit bureaus, and they also establish the alternative scoring that is used by traditional and non-traditional lenders to lend to non-served population. And the important characteristic here is that the regulator is part of the whole process as an observer, because you will find that there are many instances where there is the need to evaluate the existing regulations, to issue new directives, to facilitate and promote the use of alternative data. And if they have this evidence already from real transactions and real portfolios that have been created, it's much easier to demonstrate and facilitate the use of the information with the blessing of the regulator. Another topic that I wanted to talk, also related to alternative data, is open banking. Open banking is already taking place in several jurisdictions. In the US, there are several companies that are accessing the data directly from the banks, of course, with the consent and with the proper securities, transactional data that is super predictive for credit behavior. Some of the countries that are leading this use of open banking are the UK, who started really with the initial guidance of PSD2, the United States, New Zealand, etc. And it is third parties, any third party that meets the conditions, that can apply for these licenses and extract information from different institutions for the same consumer, for using it for the consumer themselves to understand their whole portfolio, but also for the credit providers to have a greater wealth of information to make decisions on cross-selling, on how their borrowers are participating with other lenders that they didn't know about. And here we have fintechs that are working in this space, that are not reporting or that are not part of the credit information system, but there are also some initiatives from credit bureaus who, as third party, can also access the information. An interesting thing I think here are, for example, countries like Brazil and France that are still only negative in credit information, so that they only report negative information to the bureaus that are using the information that they extract from the banks to add it as a positive data, and therefore contributing to making better decisions, because we all know that it is the positive data that allows to increase the credit portfolios. I also want to bring to your attention the new lending scheme, the buy now and pay later. And this is these are some of the statistics specifically for Nigeria. And there is a demand, a potential demand of about $2.2 billion if the tendency that is reported in the analysis continues to grow. So for buy now and pay later, I want to share with you an exercise or an analysis that did the CFPB, which is the Consumer Financial Protection Bureau in the United States, one of the most exhaustive studies on BNPL, and some metrics and findings that they had in the US could really be similar in other regions because this product is taking and being adopted very fast all around the world. So some really amazing metrics here. From 2019 to 2021, the number of BNPL loans in the US, and with only information from 5 lenders, grew 970%, from 16.8 million transactions to 180 million transactions. And the growth in dollars originated from this lending grew from 2 billion to 24 billion. The industry initiated basically with 2 main products or industries, the apparel industry and the beauty merchants, and that comprised 80% of the originations in 2019. Now it's only 58%. So it is really expanding all across the different industries, the use of BNPL. 73% of the applicants were approved in 2021, an increase from 69% in 2020, either because they relaxed the credit criteria or because there are more credit-worthy individuals out there. But one thing that is important that I wanted to share with you is, for one part, the benefits. Some of the benefits is that there is no interest and no fees, there is easy access to use these tools, and simple payment structures. But here are the potential risks that regulators are worried, and the CFPB in particular is calling for the attention. One, it's more qualitative. There are what they call some discrete consumer harms. For example, there are additional hurdles. Even though it's easy to use, there is a lack of what are the disclosures, what are the terms, how do they resolve disputes, who do they dispute and claim for wrongful information or for negative delinquencies reported, and the requirement of using autopays, at least in the United States, it's prohibited at least for credit cards. Then there is the data harvesting, collecting information, huge amounts of information to deploy models and develop new products, and the use of this information for marketing campaigns is what they worry because it compromises the consumer privacy and also contributes to over-indebtedness, which is the last risk, that is one that I would be more worried than anything. And this is created because there is this loan stacking where the borrowers take out several loans in a short period of time, but from simultaneous lenders. This information is not available in any credit reporting, also because of the short length of the period that they are granted. And then if this becomes systemic, it could really impact somehow in over-indebtedness. And this is definitely a worry of the regulators. Like I mentioned, most of the BNPLs are not reported to the bureaus. And there are some constraints that if you as a credit bureau, I'm talking right now to the bureau, are interested in addressing from now, some of the reporting that the credit institutions do is monthly, but the buy now pay loans are a much short duration, so they will disappear when it's time already to report them. So multiple transactions are made with different loans, and they appear as different trade lines, so then the credit reporting becomes super extensive, super long. And then there is the length of the credit history, which is one factor that is considered in a score. Here is FICO, but it's in any score, which accounts for an important percentage of the score, then might also impact negatively or affect the score of the consumers. So this would have to be into consideration if the BNP loans are going to be part of the system. So really, to finalize, I also wanted to bring the cross-border information sharing, because we are currently facing the crisis of Ukraine, but Africa has faced the crisis of refugees and migrants for the longest time. Some statistics on migrants that you probably already know: over 281 million around the world. Specifically in Europe and generated by the Ukraine, there is about 6.8 million that already fled to neighboring countries. And this is what I wanted to share with you. The IFC, together with Axis and the credit bureaus of the different countries, including Ukraine, have developed a digital corridor of data to allow the host countries to utilize the information of the Bureau. They had to face and resolve some of the challenges, like, for example, in Ukraine, the law didn't allow to transfer the data to the cloud, and this was allowed in a change in the law that was done overnight. They had to also perform agreements between the countries and the bureaus on the terms and conditions of how they would access the information. They needed to identify what sort of identification for the individuals was going to be used, and to develop technology to allow for accessing the information in the bureau in Ukraine. So what can be done to prepare for cross-border information from the standpoint of the credit bureaus and the governments, to allow for cloud hosting and get away from data localization, work together with the different countries on how to uniquely identify or match the original country IDs, work on agreements and codes of conduct or service level agreements among the relevant stakeholders that participate in that trade of information, and work on homogeneous data templates so that information can start crossing borders. For Africa, there is already an association of credit information, ASISA, that could be a very good place to start. And financial literacy for everybody. What are the new trends that we see? The expanding the perimeter of the credit information to cover all kinds of institutions that generate data that is relevant for credit. Look out for the open banking. This has been considered as the information as a public good, so information should be allowed for everybody to have access to, as long as they comply with the right uses, particularly in respecting the consumer protection. Technology is fundamental, basically in digitizing those that are not digitized so that they can be part of the whole ecosystem. And we can be sure that going forward, everything is around the consumer. So in everything we do, we need to make sure that consumer rights and data privacy are considered. So sorry for extending myself a bit, but I thank you very much for your attention and for the invitation to participate here. Back to you, Mary.
Thank you so much, Ma, for the wonderful presentation. In fact, coming from a data background, I've always known that decision based on data will always lead to better outcome. Like they always say, data is life. And you have made us understand that credit reporting is not only important to lenders, but also to regulators and customers at large. Thank you so much, Ma. We really appreciate you, Ma.
Thank
So
you.
for those, thank you, Ma. So for those of us requesting for the presentation slide, please note it will be shared with you at the end of this program for the registered participants. Please feel free to drop your questions as the speakers are ready and eager to attend to them all. Thank you. So our second speaker is no other person than the MD, CEO of Wide Fusion Holding and Loan Sports. He will be taking us through rethinking the concept of lending from business and economic perspective. Mr. Basiama, the floor is yours, sir. Please,
Okay.
you have 20 minutes, sir. Please, spend more time already.
Thank you very much. I will try to do my best. And I'll first of all start by saying a big thank you to First Central for putting this together. And also I'm privileged to be sitting with the panel. I'm really excited about this opportunity and very insightful, Luz Salamina. I really, really do appreciate and enjoy your presentation. So I will start by sharing my screen very quickly, if you allow me.
You can, sir.
I can't?
You can.
I can now, okay. Just a second. Just a second, please. I'll just quit and add again because it says I have to, okay, sorry, let me just put that on together. Let's see what happens there. Share my screen. Please let me know if it is shared now.
Yes, sir. You can see us.
Okay, thank you very much. I will be rethinking the concept of lending from a business and economic perspective. So why should we even rethink the concept of lending? Why should we go as far as thinking? Why do we have to rethink? Why do we have to look at it again? From my perspective and from the way I say it, rethinking basically means reevaluating, bringing changes to something that already does exist. And I like the statement by Steve Jobs, and it says, innovation is the ability to see change as an opportunity and not a threat. So this opportunity for us today, brought to us by First Central, is basically an opportunity to see, it's a brilliant opportunity for us to bring innovation and to rethink what we've already been doing, lending, and to also to see this as an opportunity. So I would like every participant, the 455 of us, well done, Mary, to see this series as an opportunity, a great opportunity for your business and for whatever project that you're doing. So why should we rethink the concept of learning in the first place? Because first of all, starting with the customers are demanding this change, and they are more connected than ever before. They want consistent and innovative learning experience. They want speed of decisioning, instant disbursement. The business environment is getting more and more competitive, and it will continue to be. The fintechs, the big techs, the niche lenders offering alternative lending products will continue to abound. And then the rise of disruptive technology, from artificial intelligence to machine learning to new initiatives like open banking, real-time and integrated solutions. All of this will require lenders and everybody playing in the lending cycle or in the lending space to take a step back and say, hold on a second, how do we rethink the whole concept of lending, especially from a business and a commercial standpoint? And even as businesses, we're always looking at the bottom line, the P&L. Are there opportunities to unlock new revenue streams? Are there opportunities to unlock scale? How do we improve our revenue? Yes, revenue might be decreasing because of one threat or the other, maybe in a much more competitive space. The last speaker talked about COVID, things that are beyond our control. Now, some of these things will definitely require us to go back to the drawing board, which is what we're doing today, to say, from a business standpoint, from our economic standpoint, we have to rethink the concept of learning. So what I have done, I have crafted up a very simple, practical guide, what I title the 3I principle, that will guide any business to be able to reevaluate, rethink, and tweak their approach to lending. And I title it the 3I principle, and it's just very simple, practical. The first is to initiate, the second is to iterate, and the third is to integrate. Now, initiate, iterate, and integrate. And I'm going to take you through this very effective approach of what does initiate mean. Number one, initiate here means starting with the customer and working backwards to your product. So what does starting with the customer means? What does the customer want? What are they looking for? What is it that they want? What is it that the customer desires? And how can I provide it within the boundaries of regulations, within the boundaries of what the industry allows me to do? So you start with the customer, understanding their needs, and then plowing back this insight into our offering. The second is to iterate. Based on how the customer is interacting with what we have offered them, based on how the customer is engaging with the experience, the lending experience, the data and the insights we gather, we're constantly learning. And then we use that to improve the learning experience. And then most importantly, also importantly, is integrating this, all of these learnings from both the initiate and iterate principle into the lending cycle. Whether traditional channels, the different channels we have, business strategy, the culture, the leadership, to ensure that at the end of the day, the customer is satisfied. And at the core of this, it's a credit bureau. At the core of this, it's a modern, digital, accessible credit bureau where decisioning can also be made faster, and also the lending experience is also seamless for the customer. So the initiate principle, we start with the customer and we work backward. How do we do it? We can do that by either carrying out a research, or we can also carry out a desktop research, which basically requires you to use very simple tools online, and some are free, some are paid for. And one of those tools, which I'm going to, if you allow me, I'm going to show you on my screen. Oops, hold on a second. I'll show you on my screen a simple tool called Google Trend. Please, Mary, can you confirm that my screen is clear? Or can someone?
Yes. I can see your screen. Proceed, sir.
So Google Trend is a very simple tool that shows you what people are searching for. Now, anonymized, obviously, because of privacy. Now, people search when they're in need. By putting in specific keywords, you can have an idea of the needs of your customer, of what they're searching for. And this will help you understand their needs. This will help you understand their concerns. This will help you understand the challenges you're facing. And this is the initiate principle. Starting with the needs of the customer, what you're searching for online, and working backwards, allowing that to plowing back this insight back into your offering, especially when you're digitizing your learning offering. So here, I would type in here, loan, the keyword loan, and what it shows me is the pattern, how Nigerians have been searching for loans over the last 12 months, category, and this is purely web search. Now, I can decide to take this to 5 years, and in 5 years, we can actually see the pattern of loan search coming out of Nigeria over the last 5 years. Obviously, there was a spike here for some reason, and it looks, that was June, July 2020. That looks to me like right in the middle of the pandemic, when it was really, really high in Nigeria, and also March 2021. But the overall is there is a gentle rise in the demand and the need for loans online. People are resorting to digital channels to look for this loan. What does this say to you as a lender? What does this say to you? This insight, what does it say? What does it mean? While this session was going on in the last 1 hour, people have been searching, and the patterns are here since 1021. Okay, so we'll take the last 12 months, and I would also put in another keyword, loan app. And I will try another keyword, online loan. And let's see what the customers, let's see what the behavior or the pattern has been like. So obviously loan app, and online loan. You can see across the country where the intensity of the search has been coming up from. This is a free tool, anybody can use it. Just look for Google Trends, and you'll be able to use that and apply that to your product. Yeah, under loan, you'll see a few brand names. Other than the brand names, you see a few brand names, you see a few, but let's leave the brand names out of this. Other than the brand names, we would see one of the things that the customer is very interested in. It's a very reliable, it's a very dependable, it's the best loan app in the country. This is a breakout search. This is what the customer is looking for under the loan keyword. And again, under loan apps, the customer is still in need of a very reliable solution, a solution that can meet their needs. And under online loan, they also want the authentic, and they want the authentic lending experience. The lending experience that is not fake, that is reliable, and they do need loan urgently, obviously, that shows that. Is breakout. That means lots of people are looking for urgent loans. And this, the third, it's online loans with monthly repayment, you know, and yeah, money minutes. Obviously, they've heard about one of our panelists here. So very interestingly, this reflects the need of the customer, and this insight, you can use that for SME loan, you can use that for whatever products that you're interested in, to be able to have an idea of what the customer is looking for, and allow this insight, plow back this insight, and helping it inform your initiate principle. I'm not going to look at search. I also want to see what are the customers talking about on social media. And for that, I would use a paid tool called Talkwalker. And sorry, I'll just put this here. I'll use a paid tool called Talkwalker that will give me insight into what they're talking about on social media. This is called social listening. What they're talking about and what is the sentiment. So if I type in loan here and I type in search and I select the country, Nigeria, it automatically will show the number of conversation going on social media about loan, the sentiment, the potential reach of the people talking about this, the engagement. But the positive, I'll leave the positive because it's mainly about brands promoting their product, and I'll focus on the negative. Let's see what people are talking about or what they have to say about loans or loan apps or lending products. A gentleman here says, and I'll read it in Pidgin, person where I won't use do guarantor, don't go collect loan, you know. And this is someone that has 5,000 Twitter followers and 434 retweets and likes. If we want to go see this, we can actually click on it and go see it for ourselves and have an idea of what the comments that people are having, the comment people have around this particular influencer, because obviously he's with 5,000 followers, he's obviously influential. I borrowed from an online loan app, but couldn't pay on due date. Threats started coming in, had to borrow from another loan app to repay. Now I'm owing 5 apps, some are overdue, others will be due next week. The threat is too much for me. This is someone that has 34,000 followers. 34,000 followers. Imagine saying that to 34,000 people. So you can have an idea, you can see what people are talking about, you can see and assess and even collate the sentiment out there, and all of this insight can help you make informed decision about what what your customers are talking about. So with these two, having shown you these two tools, there are other ways of going through the initiate principle. You can actually have a physical research if you want. So there is no bias. But again, this is just tilted to online. It's very quick on desktop. Using both paid and free tools, you can have an idea into what the customers are talking about. And then from there, you plow back this insight, whether it's on loan app, whether it's on BNPL, whether it's on lending, borrowing, whatever it is, interest rates, SME loans, whatever it is, by plowing back this insight back into the product or into your processes or into whatever you want to create. We no more go online, we live online. This generation live online. And digital technology has transformed our customers completely, from our politics to how we move, to healthcare delivery, and changing skills acquisition, and changing us the way we acquire skills, even to how we work. The last speaker talked about COVID and the impact of COVID. The impact of COVID, it cannot be undone. It's here to stay. We have to live with the concept of remote work. We have to live with the concept of gig workers. We have to live with the concept of multiple employers. We're already seeing this happening in the marketplace, in the business and in the economic landscape. So technology is already changing this, and it's definitely bringing about changes in the lending space. So we have to take a step back and rethink, how do we bring about these changes? Because our customers, they are not the way they used to be 10 years ago or 20 years ago. They have changed. We have to also realign or reach or retool or reassess or rethink or innovate our approach to lending. I'll just skip through some of this. These are just screenshots from Google Trend. We've seen it practically. Some of the most sought after keywords were loan without BVN. How do I get a loan urgently? Instant loan. These are some of the things that people are looking for, other than the brand names. I need loan urgently. I need from this and I need from that. Okay. And also, most importantly, they want authenticity. So, and some of the sentiment that we gathered from the social media assessment tool. So what do our customers want? From this initial search I did this morning when putting in drawing, or this week when putting this slide together, it's very clear that they do want trusted lending experience. They want to borrow from a trusted lender. They don't want, they've seen what's going on with the unethical methodology used in collection, which was obviously mentioned by the MD of First Central. They also want speed of decisioning and fulfillment. It has to be instant. They want a personalized experience, exceptional customer service, and definitely the long and short is they want change. The Nigerian borrower today wants change, whether it is in mortgage or SME, because they are depending a lot more on technology, and as such, they expect that whoever they're interacting with will understand them, will understand their needs, will see what they need. And I've shown you a few tools that can help you assess the need of the customer and plow that back into your decision making. So lenders must act quickly to give borrowers exceptional digital lending experience. That's the initiate principle. The credit bureau is at the core of this. At the very core for you to make informed decision is at the core of this for success. Lenders should see, you will see operating cost fall and revenue increase as you begin to unlock technology. The technology and the demand does exist in the market today. So we go to the next I, which is iterate. You have to learn how to tweak and make changes in response to how users are interacting with your product or with your technology, or based on what you have seen during the initiation principle, based on what the insight and the data you've gathered during the initiate principle. You can then begin to roll out gracefully and slowly some of these things that you have said, and then make changes based on how the users interact with your product or technology. I've seen a lot of banks, I've seen a lot of lenders, some of them, I've seen a lot of lenders, all they do is just to go build an app, put it up on Google Store, put it up on iOS Store, and that's the end. That is not how it's going to work. It's a journey that has to be done thoroughly. It's a journey that has to be implemented sustainably over time. And at the core of it, it's the consumer. At the core of it is the consumer. So personalized experience seems to be what the customer wants. How should we include this in our digital channel? That's a question a lender won't ask. It seems to be what they want. That's good. At least they initiated. They know what the customer wants. How do I then go ahead to do this? We noticed that when we launched our app or our website, there wasn't any good traction. People didn't download it as much as we thought they will. What changes should we make, can be made? Our customers seem to be more interested in payday loans, but we are keen on growing our SME portfolio. What do we do? That's another lender. How should we as lenders explore innovative ways to increase profit, new income streams, and not only rely on cost optimization? We're getting lots of young thin file borrowers inquiring on our website and digital assets. What do we do? Now, some of these questions will aid you in iterating, and the way you see that these users and borrowers interact on the platform, this can then inform your decisions on what to do next. To iterate very simply, start with the first principle, obviously, initiate, understand clearly the needs of your customer, and learn from what they're doing and the way they interact with your product. Ensure that your underlying system and the entire customer journey meets these needs. Use the right technology at the right stage of the credit cycle. Example, automating credit decision. Because of credit decision is so important to automate credit decision. Example, you leveraging the API solution from First Central, the X-Core solution from First Central. Do not try to build everything yourself. Know when to partner with a fintech, or know when to partner with a service provider. Know when to outsource and know when to build. It is a very capital intensive exercise, so you have to approach this tactically, and you also have to approach this understanding where you want to be ultimately. Integrate. Integrate basically means bringing together the traditional and the digital, bringing together your strategy, your products, your system, your processes, including the organizational culture, to bring everything together. I mean, I like what the first speaker talked about, and she talked about using alternative data, putting that side by side with the traditional credit bureau data. That's a clear example of integration. And she mentioned how this would be good for thin file individuals. That's a brilliant way to integrate. So you don't use it in silos. There has to be a handshake between what you're trying to do and where you are right now. Remember, we don't more go online, we actually live online today. To integrate, you need to integrate and partner with flexible. There are different ways to go about it. Partner with flexible, easy to integrate fintech solutions. Insights and innovation should not be in silos. They shouldn't be rolled out in silos, but with existing systems. There are a number, a litany, a myriad of API solutions that are out there that can automate your lending experience, that can give a personalized experience to your lenders. You can take the credit bureau data and enrich with your first party data that you've gotten from your customer, so that you can make a much more informed decision. You can cross-sell other products to the same customer based on the data you've gotten from the credit bureau. And even for businesses, you can get, so take for example, in my business, what we've started doing is we've started, requesting that some of our employees, before they get hired, we need to be able to see that you're credit worthy. Because what we realize is that a number of employees, some of them do change their jobs, do change their phones. Why? Because they are heavily indebted to one company or the other. So integrating all of this is very important, and integration starts from the top. I've had meetings with board of directors and leadership of certain lending companies, and none of them could tell me what artificial intelligence or machine learning is. It is so important that the younger generation should also contribute to decision making. Because when you integrate the capabilities of the younger generation, while still recognizing the mentoring of the older generation, the older should still mentor these ones and to still nurture them. but let's give them a chance. We must give the younger generation a chance in decision making, especially when you look at the average age of the Nigerian population is between 18 and 20. It makes a whole lot of sense to allow the younger generation to also be vested in the decisions we are making. So integration is not just about technology, it's also about organizational culture, decision making, integrating the existing technology in the banking system, and also the new external technology, maybe from fintechs. And most importantly, by integrating with fintechs, you can give your customers the right experience of speed, convenience, and great technology experience. This is one way lenders and businesses can rethink the concept of lending. I really do love this quote by Anna Selma. And she said, to be successful, the bank of the future will need to embrace emerging technology, remain flexible to adopt evolving business models, and put the customers at the center of every strategy. Now, if you look at this quote, it actually does have the 3 I's in it embedded. Who can tell me where these I's are? I'm going to help you. Put customers at the center of every strategy is the initiate principle. Flexible to adopt is iterate. You're flexible, you're willing to make changes. You're flexible to adopt evolving business models. And embracing emerging technology is integrating. You've accepted it, it's here to stay. I have to find a way of allowing it into the system as long as it passes the checks and balances that we do have in place. Again, coming back to the 3 I principles again, this is very simple. This is very key for rethinking the concept of lending. 1, initiate, start with the customer, walk backwards to your offering. And then number 2, keep improving your concept of lending by learning how customers are interacting with your platform and plowing back, most importantly, this insight and data back into your product, back into your service, and integrate what your findings into your existing system, your processes, your organizational culture, the technology. Don't try to build everything yourself. Know when to outsource, know when to build, know when to partner. And at the core of this, it's a digitized, modern credit decisioning system offered by the Credit Bureau. Another quote here is by the CEO of Google a year ago. Increasingly, we are seeing innovation begin in Africa. Now, I highlighted innovation because, in my opinion, if I had my way, I would change that word, but it's not my quote, so I can't change it. Increasingly, we are seeing innovation. I would call it rethinking, begin in Africa and then spread throughout the world. Example, mobile money. This momentum will not cease. It will only increase as 300 million people come online in Africa over the next 5 years. It is here to stay, ladies and gentlemen. We must get moving, and we must get moving immediately and now. Thank you very much for your time. Thank you very much, ladies and gentlemen. Thank you very much, Mary. Thank you very much, First Central. And just a second to talk a little bit about LoanSpot. LoanSpot, we offer different products to lenders. We have a collection as a service product which helps lenders to auto-collect loans when they are due, obviously in an ethical manner. And if you want to know more about this product, send an email to abaz@loanspot.ng, an origination as a service that helps you acquire pre-qualified customers eligible for your lending product. Thank you very much for your time. I'm totally grateful. Thank you.
Wow, what a wonderful section. Thank you so much, sir, for shedding light to this topic. I personally have gained a lot from you, sir. We no longer go online, we live online. Thank you, sir. I've taken note of the 3 I's principle, and focusing on customers is always the best way to deliver value to all stakeholders. Thank you so much, sir. I enjoyed your section, sir.
Thank you.
Thank you. Oh, welcome, sir. Okay, without wasting further time, we'll be calling on our top speaker, the Managing Director, CEO of Richway Microfinance Bank, and the current chairman of National Association of Microfinance Bank of Lagos chapter. He will be taking us through rethinking the concept of lending from aspect of experience and requirement from prospective borrowers. As we've seen from his profile, he has over 30 years experience in lending space. So he has a lot of experience to share with us. You're welcome, sir, Mr. Oni. Over to you, sir.
Yeah, Mary, thank you for that introduction. I appreciate it. I hope I'll be able to meet your standards. I also want to commend you very much for being able to put this program together. Just like as mentioned by one of the speakers, to have an audience of about 450 is a major effort on your part. So we congratulate you and the Force Central for the successful event. The second one on a lighter note is that I'm a banker, and you have put me in a position to speak from a borrower's point of view. So I'm not a banker as far as today is concerned. Let me look at it from a borrower's point of view. I hope I'll be able to represent them well. This topic is very crucial and is timely. Why? Last year, in 2021, we disbursed about 35 trillion naira loan in Nigeria to the private sector. For a country to disburse 35 trillion naira loan shows a lot, shows the importance of this subject, and shows why we want to look at credit and credit and credit, so that we can have much improvement, because it's a pivot for development of any country. But interestingly, out of the 35 trillion naira loan disbursed by lenders, various lenders, core banks, and other forms of lenders, business got about 92%. That tells you that the issue of lending to business sector is crucial. Just partly 8% went to others, that is individual. So lending business focuses on two aspects, as we know, the business and the individuals. Can you share my screen, please? I guess you have my presentation. Can you share it from your end?
Yes, sir, we can.
Can you please, let's
sir.
I will just take 3 of the slides.
Okay, sir.
Yeah, thank you. The business of lending actually focuses on 2 main areas, that is to business and individuals. And the business is controlling about 92% of that lending business. But let's look at each of them to look at why maybe the lenders might want to focus more on one than the other. That's I'm on slide 1. Yes. Definitely the corporates, they have a lion's share of credit being disbursed. Of course, mostly they are price giver. They dictate what you will give to them in terms of pricing. If you give them 22, they tell you, no, I want 15. And you just have to honor them because of the volume of business they are controlling and the volume of their transaction. Then they also seem low risky, so to say, compared to other areas. But when the bubble bursts, they can have high value NPL. No wonder the AMCON of this world have actually come to the rescue of banks to take over some of these toxic assets, because they are actually very heavy. So when the bubble bursts for such area corporates, it can actually have serious negative effect. Then we also have the SME. Ordinarily, the SME is supposed to control the by UN and the Bureau of Statistics. SME is actually the core on the pivot for development of any nation. They control the 85% of any country GDP. But unfortunately, when it comes to lending, they have patchy share of credit. They need more loan, but they only have access to very little. That in most cases is not always sufficient for their need. But they are price taker. Even when you tell them you are giving them 40% per annum, they don't care. As long as you give me the money, I'd rather take your money than wait for 6 months from conventional banks. They take loan at any price because they are really desperate and they just want to deliver. So most times lenders take advantage of that desperation in some instances. But definitely they also deem high risk. It's an area where lenders lose a lot of money. Yes, they take at any price, but at the same time, the propensity to lose that money is very high. So no wonder financial institutions that are focused on SMEs, in most cases, will record high percentage of non-performing loans. But aside from SME, we also have the micro business. These ones have low access to credit because of so many reasons that we are going to discuss in the next slide. They have no credit history. So when they come to you, you cannot really think about what have they done in time past. So you taking decision to lend to them is always challenging. They are generally termed unbankable. No wonder most of them, when they come to you and they go all out being frustrated because they are always being said to be unbankable. The worst aspect of this is the startup. Nice ideas. He wants to do well, but there's no lender who is ready to support because no history. Although sometimes when you see their feasibility study, when you consider their plan, you just realize that it's good, but to take the risk on them is always challenging. No wonder a lot of good ideas are not being able to come to fruition because of lack of support from financial institutions. That is a brief description of the business aspect of financial services. But what about individuals who are also growing? Their share of credit is greater than SME. You can see the way MFIs are granting loans to individuals lately in tens and tens of billions of naira, because they are automated. The people get loan within 10, 15 minutes of their request. So no wonder today you will realize that the number of individuals are becoming heavily indebted. Check credit report, when you view some guys, you realize that it's indebted to 10, 15, 20 MFIs. Sometimes too, they are just no longer bankable because of high exposure. They are mostly price taker. They don't care. MFIs take advantage of them, not MFBs. MFIs give some, they lend to them at 15% flat monthly, 20% flat monthly, taking advantage of their desperation. Some MFIs may think, yes, let me just charge them 20, 25%. If they do not pay, at least I've been able to, in 2 months, I've taken all what I've given to them. So they are mostly price taker. They seem mid-risk. There has been this argument, are they really low NPL or not? Yes, you have a standing order set up against their salaries or their income. But just like the last speaker says, there are instances of diversion too. When my salary is being paid through First Bank and I'm going rich way, I'll just go to, and this is tied to my salary, my monthly repayment. I'll just change my salary to First Bank or to UBA just to avoid that standing order that comes through. We are recording a number of MFIs are having this kind of bad experiences lately. Then we have former workers. Yes, former workers, they have better share of the credit, yes, because of guarantee salary. They are price taker, they deem high risk, and they are now bringing high percentage of MPLs, that is former workers, because of being highly exposed to a number of lenders. The first one, sorry, was actually the high net worth individuals, the affluents. Those ones are actually given low MPLs. Then the last one is the informal worker. They have low access to credit. They do not have any credit risk, and they're ready to take loan at any price out of desperation. I guess this is a brief description of an overview of borrowers in Nigeria context. But let's look at what are the issues. We are going to take some of the issues that borrowers face when it comes to borrowing. One is a KYC issue. The second one is a credit history. These are major ones. KYC, credit history. Let's take Chief Udogodo, a trading company. He's a big merchant in Aja market. He needs huge credit for stock replacement. But due to post-COVID-19 issues, there is a change to the supplier's credit that he had access to. Before now, they were giving him 100% credit, but today they said, no, you must pay cash in advance because everyone is struggling today. But can he have access to funds? He has unregistered trade name. He has no bank history. But to his suppliers, his credit worthy. Stressful validation of other bank statements. He has given us 5, 6 bank statements. You want to verify the statement he has given to you. Sometimes you find it very difficult to do, so you don't know how to take decision on it. Then, from the statement he has delivered, he has done very high turnover. His resources are in defective form. But mind you, despite all the negativity that you have brought up, yes, history, unregistered trade, no. But with his suppliers, he has good credit history. So should you or should you not give loan to such? How do you decide whether or not to expose your company or your bank to such a person? These are decisions why that needs to be taken. Let's take another client, Rafiu Construction Company. He won a 5 billion naira government contract to deliver a new court building in Lagos. But what are his issues? Yes, he has a contract. Bad credit rating, because in 2014, he has a loan default to Federal Mortgage Bank. Should you now still expose your company or your bank to such a person when it's having a negative credit history? But in his statements, he has good turnover. He has done billions and billions of turnover. He has good industry reputation. He's a super customer when it comes to experience. He's credit worthy with his suppliers. Can you use these 3 to make a decision on him? He has given 4, 5, 6, 10 bank statements. Sometimes there are stress in verifying such too with banks. Now, what decision should you take when it comes to this? So you can see experience being faced by different borrowers based on who they are and their kind of business. What about the third person? Let's take 55 laborers in an informal, in a company. They are informal workers, so they have tier 1 accounts. Tier 1 accounts, you can do up to 200,000 naira without proper documentation. You can just open such account with no documentation, but because they are tier 1, he also needs loan. Will a bank give them such people loan? When you flag them, no KYC, no credit history. You will even get letter from the employer. So how do you go about this? So presented here are 3 case studies. This is typical everyday life that lenders face when it comes to borrowers. How do we go in resolving such. So there are two suggestions down there. There's a need for the system now to have a seamless, independent transaction data beyond the banks at an affordable rate. I guess even the first, second presenters, they mentioned alternative data. No wonder on the top of the slide, you can see in red ink, the need for alternative data. Maybe now that Mary and First Central has brought us together, how can we provide data? How can we bring up ways of assisting this kind of borrowers so that they can meet KYC requirements? At the same time, we can be able to have some element of history. What can we fall back to? Sorry, I'm still on that slide one. Can we have something on the credit industry report? Can we have a sectorial report from where they are trading at affordable rates? In other countries, I will use South Africa as an example. Apart from credit report, you also have credit scores. Can we now conclude? I know there are preliminary works being put together on having credit scores. At this, can we rely on this as lenders? For Chief Udogoga, for a few construction, for the 55 informal workers, how can we rate them? Maybe if maybe a First Central can take a lead in this aspect, if there can be scores so based on parameters, maybe that can be part of what lenders can fall back to in taking decision. Yes, the CBN BVN has been successful, but with the iCard CRM MS that are now that is now upcoming, I know a number of commercial banks have started using it. It is not yet extended to microfinance banks for loan collection. Maybe when this is extended to other sectors of the financial market, the possibility of this kind of borrowers to get loans to finance their business and for their personal use can be better, because a lender wants to be sure that when it comes to payment, I can get my money. So that is why when we commend CBN for bringing up the CRMS iCard, and we hope that very soon, using this aspect of tool or this product will be extended formally to the microfinance banks, to the mortgage banks, to the finance houses. If that can be finalized, you can see that more of these borrowers, they will get more access to funds, because, you know, if someone is rolling a rich way microfinance bank, I know I have access to his account in all the 24, 25, 27 commercial banks. And I know I have access to all his accounts in the over 700 microfinance banks in Nigeria. So with that, once he signs the contract that I can offset his loan or indebtedness from any of these financial institutions, that will add a lot of value to borrowers getting more access to funding, more so when they have bankable projects. So you not only rely on credit history, you know, yes, the contract is confirmed, you know, he has good history with the suppliers, he has a good performance record of past jobs done. So, and you know that your access to getting the money, even when he's paid and he leaves UBA, he runs to Kuda, or he leaves Kuda, he runs to Axion, or he leaves Axion, he runs to Zenith. We know that you still have access to that fund. You can take your loan. That also will encourage more of the borrowers. I think that is my take on this. So let's go to my last slide to look at 3 other case studies. That Suda company is an emerging conglomerate. It's not yet Nestle. Neither is it Nigerian Breweries. He has applied for a credit for a time-bound transaction, and the review process took longer. Of course, every borrower wants it like yesterday. Why do we experience, we borrowers, since I'm not a borrower, why do we experience delay sometimes? We submit incomplete documentation, despite the fact that the bank has provided some borrowers with detailed checklist, they will still come back and not bring complete documents, and they will say you can continue. So you experience a lot of back and forth. Some still for 1 month, they are yet to come back with full documentation. That delays lending and disbursement, credit approval and disbursement. Sometimes from the lender point of view, the analyst also send mails to wrong emails. The customer, Dansuda, has given you, my email is dansuda at gmail.com. The banker will send it to dansud at gmail.com. The guy will be calling, I've not seen it. He said, I've sent it. I've not seen it, but I've sent it. That delays a lot of things, and the customer becomes frustrated. Sometimes surface may go to the applicant late. So, of course, you may not be able to verify some of these bank statements. Even when you sign on to the NIPS e-statement, we still experience delay a lot. And then you may not be able to verify statement on time. So approval will take a longer time. And by the time you now give final approval, the guy says he doesn't need the loan again because he has moved on. So this is real life experience that borrowers are facing. Let's take Okoro company. He applied for a commercial construction loan, but what are his issues? Poor cash flow reports. He doesn't have audited financial statement, which is common. It's very, very common. Purpose not in object clause. But look at this. He has good record of construction delivery in the last 6 years. He's a super customer. He is creditworthy when it comes to suppliers. Should you still go ahead to give him loan, despite the fact that you cannot validate his statements, despite the fact that he cannot give you audited financial statements? And you still give you loan when he cannot really give you a cash flow statement that will justify that that money will come back and it's a viable project. This is a real life experience. So lenders sometimes, especially the formal lenders, the commercial banks, may not touch it. What about Omoluton Commercial Limited? A new company with brilliant bankable idea. He has applied for loan. No credit history. Doesn't have audited report. Low value when it comes to his shares. But mind you, the executive directors of the company, individually and collectively, they have a good track record when it comes to performance in the market. Members of the board, they have good credit history. Should you be exposed to such? What are the recommendations? There's a need for process improvement and automation of loan application. I'm happy when the last speaker, when he mentioned automation, the need for digitalization. We're happy to know that a number of lenders are doing this now. MFIs are doing, MFBs are doing. Commercial banks are also introducing this beyond the conventional review of papers. It's now evolving. So we want to believe that in the nearest future, banking business will be automated to a reasonable extent, if not all, because definitely even the issue of automation may not be used in all instances. If somebody has come for a 2-3 billion naira transaction loan, you want to look at some things. So, but we want to do more and more of automation to improve delivery. Our processes has to be reviewed. A situation where even the loan officer does not get himself familiarized with the checklist, it brings challenges. And when the loan officer, the customer has brought in the document, he said, yes, it's fine. When it gets to the issue of review by the credit review team, they realize that there are gaps. We now call the customer. The customer becomes angry and tells you, hey, but after you guys said everything was complete, why are you coming back with excuses again? So the lenders, bankers, loan officers, supposed to also improve themselves with the process in their system so that they can attend to customers' requests on time. They can let customers know as on the spot when there are issues with document submitted. It's also suggested that loan applicant could do with support from independent professional support and educational support from the banks. I guess a First Central might come in here. What kind of education, what kind of product can we come in that borrowers can come into to plug into to make a credit analysis for them to be much more easier. The advocacy for amendments to prudential guidelines, we thank God that is now being taken. So when this is also done, I know rules guiding credit will also be improved. But in conclusion, I want to emphasize that the likes of credit bureau, and I'm happy First Central is taking the lead here. We should now go beyond only credit reports. Can we have credit scores? It is something that may not be that easy. I know, and I know it's upcoming. Can we make it much more objective such that the lenders, the bankers, the financiers can really rely on such scoring? Maybe that will make things much easier and faster for the borrowers. I guess I will have to stop here, and I want to thank Mary for the privilege to speak at this program. Thank you.
Thank you so much, sir. Thank you so much, sir, for that wonderful and brief and precise presentation. Though we are in the age and time where money can buy you everything, yet money can buy you experience. Experience has spoken. Thank you so much, sir. Your last slide look as if you peep into our strategy document, especially the point number 5. First Central is leading in the change to empower MSMEs and SMEs to build a quality credit report and scoring by treating all their credit dealings as facility. In fact, we already have credit score, and we have reached out to so many MSMEs to see they buy into that. Thank you so much, sir. We really appreciate your presentation, sir.
Mary, I will send in my bill for the last slide you mentioned.
No worries, sir. We are together in this, sir. Thank you, sir, for all the support, sir. Okay, sir. Okay, thank you, everyone. Thank you, Madam Salamina. I can see you are attending to the questions. Wow, thank you. What a great job. Thank you, ma. The last but not the least of our speakers is the Managing Director, CEO of Money in Minutes. He will be taking us through rethinking the concept of lending from fintech and the credit space. Mr. George, over to you, sir. I don't know if you can do justice to this topic in, let's say, 10 to 15 minutes because of our time, please.
Yes, I am well aware that we're so behind on time. Good afternoon, Mary.
Thank you,
Firstly, I'd like to thank our friends at First Central for inviting me to participate in such an important discussion. It's a privilege to speak alongside exceptional professionals within the finance space, and I have taken a lot of notes from all the speakers. Very, very interesting views on this particular challenge. I also want to thank all viewers. What a great turnout. So well done to those at First Central for putting all this together. Mary, if I knew my bio was something you're going to read out, I would have provided a more succinct version. So I apologize to you for putting you through the trouble. As my bio identifies, I am George Badejo Adebenga from MIM Finance Company, trading as Money in Minutes. We've been in the country now for over a year, actually going to 2 years, considering we were incorporated in February 2021. Our mission at Money Minutes is to make affordable finance accessible to as many hardworking Nigerians as possible. In terms of my experience, let's just say I've been in both the legal and finance space for over 20 years. I've done all sorts of credit management activities, from doorstep collections to managing contact center for collections. And I've been exposed to developing strategies for various types of debt, whether it's credit cards, secured, unsecured, mortgages, and most recently, subprime debt. But here's a quick disclaimer. Operating in Nigeria is very new to me. So I do not profess to be an expert, but I can share perhaps my observations and analysis from what we've experienced thus far in comparison to my previous exposure outside the country. So this topic is really about rethinking the concept of lending. So I think it will be better if I take us back to basics. So I'm just going to share my screen if you bear with me a second. Okay, just let me know if you can see my screen.
Yes, I can see your screen.
Okay, cool. All right. So the first question is, how does lending and borrowing work? So I've thought that it's perhaps better to take a more simplified view or journey as to what this is really about first before we start to rethink the concept of lending. So there's the obvious insofar as what lending really means or borrowing really means. And that is, as we all would be able to kind of conclude, there is a lender somewhere that's got money and willing to give it out to a borrower in consideration for interest that will be repaid over a period of time. Now, what is not so obvious to many people is that how does a lender even get the funds that they actually lend out? And how is the interest rate determined? And I think this has been referenced by previous speakers with regards to some of those challenges in actually even determining interest rate or what actually makes interest rates so high in many cases. So I've identified here the source of funds. So this is pretty much the general source of funds for most lenders, no matter where you are in the world. The first is investors fund. I'm not going to go into detail right now because of the limitation on time, but I'm sure most of our viewers here can kind of, make sense from what we mean by investors funds. And also funds is generated by debt, where a lender goes to go borrow money at a particular rate and then would then relend that money at a slightly higher rate for them to actually make their profit. And then, of course, savings from consumers. So this is pretty much more for the commercial banks and the microfinance banks and those that do have the license to actually take savings from consumers. So this is how funds are generally generated. Now, you then look at what determines the rate, and that's very, very important. Tells us a lot about some of the challenges we face in this particular space in Africa. So I've identified two factors, if you like, that determines rate. The first being risk associated with borrowers. So lenders' first task is to assess the likelihood of borrowers repaying when products are developed. So if you can imagine, the higher the risk of default, the lower the rate. And as Miss Salamina stated, this is pretty much what drives the so-called risk-based pricing. And you see that across different lenders, where your individual risk would determine the rates that would be aligned to the product you're looking to borrow. So in reality, you would find credit risk is somewhat mitigated by bank guarantees, where a borrower would come with a bank guarantee to show that they can actually afford to repay. And if they default, then the bank will be able to honor the debt. You get to see lenders providing product that requires a guarantor. You get lenders asking for collateral. And of course, borrowers with very good credit score, as Mr. Peter mentioned, would also determine whether that customer is creditworthy or deserves a low interest rate. Reliance on collateral pretty much explains, if you like, why secured loans are more affordable than the unsecured loans. It's pretty much that risk factor. Now, moving to the other factor that determines rate, we're now talking about the actual cost of actually lending. So whether it's your marketing cost, your cost of KYC, know your customer activities, the cost of affordability assessment, loan processing cost, the disbursement cost, and in some cases as well, the post-lending administration cost and collection cost. These are all the factors that lenders would look at to then determine what kind of rate they would provide. And in this particular space in Africa, most of all this are very expensive because there's lack of information, there's lack of facilities that would make it easier for lenders to be able to provide much more affordable price loan, if you like. So I'm just going to move to the next slide. I'm going to be as brief as I can. So why is access to finance still a challenge in Nigeria or across Africa? So data tells us that circa 60% of Nigerians lack access to finance. So if you start with the biggest challenge, there's always been the case, and this has improved for over the last 3 years, is the proximity to banking service. So, people do not have a bank or a finance firm in close proximity to where they live. And whilst this has improved significantly, especially in the urban areas, if you look at the remote areas, the challenge is still there. The government are doing a huge work in trying to bridge this gap, but there's still a long way to go, considering the population of a country like Nigeria. Now, the second is the poor financial literacy. And I've bolded that because that is very, very important. We found that there's a big challenge, right? So it's so easy to get the funds to actually lend out, but then you could do whatever assessment. You could even ask for bank statement and go through different ways, Mr. Oni rightly stated. But then, do the borrowers understand the importance of actually paying back on time? Do they even understand their own income and expenditure? Do they understand that if I take an interest rate loan for 20% a month, that would have an impact if I don't pay on time, and then interest has to accrue? Data tells us as well that 53% of Nigerian adults do not know or only have a rough idea of what they spent in the past week, right? That is how huge poor financial literacy is as a problem. So that is one of the reasons why we are where we are today. There is also not enough legitimate players to serve the growing market. I'm sure I've heard so many times that people say, well, the lending space, the fintech space is saturated and there's loads of players. If you think about the population and the amount of people, even excluding the unbanked, right, we've still got a long way to go, and we do not have enough legitimate players to serve this market. Now, interest rates are very, very high, again, linked to exactly what we've talked about in terms of high rate of default. There is also limited data on prospective consumers and their propensity to pay. And this is the part where perhaps the credit bureaus, the likes of First Central, comes in to kind of ensure that they can actually do some good in that regard. And another very big challenge is the difficulties verifying customers' current residential address, right? So if you compare us to the likes of the United Kingdom, where there is a database for where everyone lives, right? It's called an electoral database where everyone, where you live, even if you move, it's all tracked, right? We don't currently have that in Nigeria and many other countries in Africa, right? And that becomes a huge barrier for lenders in order to kind of determine whether they can take a risk on a customer or not. I'll move to my penultimate slide. So how did we actually get here? I'm just going to quickly, briefly go through this because I'm conscious of time. So as I mentioned before, poor financial literacy is a huge problem. The high rate of poverty is also a huge problem, right? You could borrow money to someone, and of course, if the circumstances change, food, shelter, school fees would always take priority, and that would always lead to the outcome that the lenders do not expect. There's also the fraud menace as well, which is a huge factor, and it's causing discrimination across the entire spectrum, where some lenders are deciding that because of high rate of fraudulent applications in a particular region, they would not even go there at all, which you cannot blame them, but those are the realities that we faced in a country like Nigeria. The increase in cost of living as well is a big barrier and a big change. You can borrow someone money and you've done a thorough assessment based on the previous 6 months, but what happens in the front 6 months determines exactly how they actually perform, and this is a big issue. Entitled borrower is the last on this particular point, and this is something that we've experienced. I'm absolutely sure other lenders in the market are experiencing the same, where borrowers feel entitled, right? It's, they come begging at the point when they need the loan. And when you grant the loan to them, they feel entitled. They start to challenge you, they start to abuse you, and they feel that perhaps whatever loan you give them is in effect a grant, right? And I think the government also saw this when they actually lent to some agri lenders, consumers as well, where most of them failed to pay because they saw the loan from the government more as a grant than an actual loan. So these are some of the issues that have actually got us to this challenging space, if you like. Now, the final point here is, what does good look like? And I think if we're going to rethink lending as a concept, right, we need to think about where do we even want to be? What does good really look like? And I've identified 4 points here. The first is an industry-wide data sharing culture across all the credit bureaus, right, whereby even credit bureaus can share data between themselves, right? So that you have consistency in the data that you're actually using to make a decision, right? And without stuff like that, it's really, really going to be difficult. But if you have that, you've taken a better step towards what really, really looks good and what would open opportunities within the market. Open banking technology as well. I think Ms. Salamina mentioned this as well, is very, very important. Embracing some kind of open banking technology that is perhaps backed by regulation. So this is not about what the industry wants to do, but the government is actually driving open banking where, people can give consent for lenders to be able to see through all their transactions across all banks and financial institutions, and then make the right kind of decisions that ultimately would be in their favor at the end. Also, an effective mechanism that can compel borrowers to pay. And I think Mr. Oni just mentioned this. So this GSI, Global Standing Instruction, is key, right? That would allow lenders to be able to borrow money. And if you default over a period of time, they have access to all your facilities, lending facilities, borrowing facilities, savings facilities, to be able to recoup their money back. With this mechanism, I think that will start to change borrowers' behavior, because they know that you cannot hide unless you want to get off the full banking finance system. You cannot hide from your obligations. And I think hopefully that would be stuff that would drive the right outcomes for consumers and also for the industry. So let me just conclude now. I'm really conscious of time. Perhaps maybe another day we'll be able to dive more into the detail. How do we move from where we are now to where we want to be? So first is education. I think all speakers have actually made reference to this, and this is an obligation for everyone within the industry, trying to help bridge that gap in financial literacy so people understand the value. Actually going into elementary, going to schools to start to teach pupils how to manage money, what it means to save, what it means to actually have a good credit score, because by having that kind of insight and information, it will only but do them good. We also need more lenders acting responsibly in terms of data sharing and ultimately whom they lend to, right? We get loads of lenders acting irresponsibly, giving out loans without doing proper affordability assessment and maybe relying on collateral, right? Because they think that if you default, I'm just going to take your car. But those are irresponsible way of actually engaging with borrowers. So we need to see more lenders acting responsibly in that regard. Also, credit bureaus should also consider what is of great value to them. And I'm speaking from experience, right? This is not having a dig at any particular credit bureau, but ultimately they need to really think about what do they see as value in the short term and long term. I know for a fact that so many lenders have actually decided not to share data simply because it's too costly to get credit bureau information. So if credit bureaus can really think about, be more forward-looking perhaps about maximum participation than minimum participation. The more data you get, the more powerful what you provide as well becomes. Now, the penultimate point is CBN needs to carry on with its goal of increasing licensing for microfinance bank, mobile money, finance houses and agency banks. I don't think we've got enough players in the market. So we need more players in order to actually be able to serve this market and for us to compete, elderly within the market. And the final point is the state money lenders. This is going to be a tough one, but this is more speaking to CBN, right? There are a lot of money lenders. They're not regulated by CBN, so they do not abide by the rules of CBN, right? And they're operating, and to a degree, they're doing good, right? But also another degree, they're actually creating a bad reputation for the industry. So they need to be transitioned into under the CBN regime. So all legitimate players can be playing from the same field and under the same regulatory oversight. So I hope I've not done too bad to speed all that up, just simply because we're behind time and I've also got a meeting, but I'm happy to stay and take some questions. Thank you, Mary.
Thank you so much, sir, for the insightful presentation in such small time. Thank you so much. In fact, within this short time, you've been able to outline what lending is all about, the challenges of lending, the level at which we are operating in, where we expected to be in lending, as well as the possible steps we can take to close the gap where we are and where we're expected to be. Like you mentioned, for the credit bureau, especially for Central Credit Bureau, we have a lot of products that lenders can take advantage of. With little amount of money, with little money, as low as 100 naira, 50 naira, 70 naira, different type of product, you can have access to it. And it's quite, it has a lot of information on those products. So if you're interested, you can reach us. We will also introduce you to these varieties of products that you can access to get information to make informed decision. It was an awesome presentation, sir. Thank you, sir. Okay, let's move straight to the question and answer section. Mr. Bass, over to you.
Okay, good afternoon, everyone. We've had questions from Akan Usoro, Edwin Higa, Onomeako, and a host of others. And this question have been adequately treated by Ms. Salamina. Thank you very much, ma'am. But there's a question from Fadeke Badejo, and she would like to know how the lack of robust geographical data is affecting the lending space in Nigeria and Africa as a whole. I think that question is directed to Ms. Salamina again. I don't know if she's available to take it.
Thank you. Could you read it again? Sorry.
Okay, she would like to know how the lack of robust geographical data is affecting the lending space in Nigeria and Africa as a whole.
So maybe I would need some clarification about geographical data. Would this be like GPS information on borrowers, or is it the distribution of borrowers in the different geographies? Some of those geographies are harder to reach, and then they require special attention, particularly if we want to digitize and take advantage of the technology. It is very important to segment the whole geography of the country and then of the continent, maybe, to define strategies to be able to reach those. But I'm not sure if I'm addressing the question correctly.
I hope so, ma'am. Okay, that will be all for now, since you've responded to most of the questions already. As for those who are asking for the slide will be provided at the end of the event. Will be shared with every participant. Madam Mary, over to you.
So it has been a great, an engaging section, and I believe that we have learned a lot. One of the things that we cannot neglect in our pursuit for perfection is learning irrespective of our age, experience, and exposures. And I believe today that we have learned one or two things from the concept of lending. As an individual, organization, or possibly a regulator, First Central, as a risk management organization, is always looking out for opportunities to assist individuals, organizations, and sectors to maximize their value realization. So thank you so much to all our speakers for doing great job in handling this topic. Ms. Luis Maria Salamina, Mr. Abasia Maidaresi, Mr. Dere Leoni, Mr. George Adebanjo Adebwega, Mr. Tunde Afolabi, thank you so much, sirs, for honoring our invitation and speaking to us. And to all the First Central team that put this program together, thank you so much. Time will fail me to start calling out your name one after the other. And to our able MD, we say thank you so much. And to our participants, we say thank you for leaving your busy schedule to join us on this program. I believe that you have learned a lot that will help you to advance your businesses. Once again, thank you for being part of our family. We are very grateful for your continued patronage and look out for more of our webinars coming up soon. Thank you and God bless you. Okay, please wait before I forget. Can we all put on our cameras for an e-photo section? Can we all put on our cameras? Mr. Abbas, Tunde, Olamide, can you take us on that? Can we all put on our cameras? Are we ready? Okay, we can proceed.
Done.
All right. Thank you all and God bless us all.
Thank you.
Thank you, sir. Mr. George, thank you. I appreciate. Bye.